You know, there are some Facebook and social media posts going around. People suggesting that their banks and investment companies are somehow shaving off some of their investments, like they are losing money, right? Is that true? Is that what is happening? We have the answer. Stay tuned. Get that explanation once and for all so you know what is happening with your investment, so you know that it's safe and you don't have to panic. Stay tuned, that's to come. But first, getting cash on the go from an ABSA ATM is now so easy, even when you don't have your contactless ABSA debit card with you. For the first time in Ghana, you can withdraw money from any ABSA ATM with the ABSA mobile banking app using a QR code. It's easy, it's safe, it's convenient. Just open your ABSA mobile app, select ATM QR cash to scan the code on the ATM screen, follow the prompts, and get your cash out. That's another digital innovation that gets things done. That's Africanacity. That's ABSA. Download the ABSA mobile banking app now to get started, or visit the nearest ABSA branch to sign up.
And Vena water is proudly made in Ghana by Twellium Industrial Company Limited and is purified using a series of filtration, reverse osmosis, UV sterilization, and ozonation to meet high standards of quality and safety. Vena is ISO certified and has also been awarded the Water of the Year at the Ghana Beverage Award 2021, Product of the Year by the Ghana Manufacturing Awards 2019, Water Producing Company of the Year by the Ghana Manufacturing Awards 2021. Purchase a bottle of Vena, which comes in 330 ml, 500 ml, 750 ml, 1.5 liters, and 15-liter jar. For bulk purchase, contact 0249 717777. This advert is FDA approved.
Okay, penny the penny, right? Pedigree knows pedigree. Yes, that's what happens when Mercedes-Benz and CFAO Ghana come together. You might not know the CFAO has been in Ghana for 113 years. But finally, the star comes home to CFAO as global automobile giant Mercedes-Benz joins the stable. So they are now, CFAO is now the sole authorized distributor for Mercedes-Benz here in Ghana. The preparation of a new showroom is underway so that you can immerse yourself in a new world of Mercedes-Benz at CFAO with world-class after-sales service. The Star is now home. Call 0302 742 100 or 020 222 1406 for more information.
And Apollonia City invites you to the 2022 edition of our Family Day. Apollonia City is Accra's newest $250 million city equipped with state-of-the-art infrastructure. Come and network with other like-minded executives and business owners and take a tour of our futuristic city as we explore the most viable investment options in today's tricky market. Now, there'll be loads of good food, very good music, bouncy castles for the kids, and so much more. Join us on Saturday, 12 November 2022 at the Edumwa place located at the heart of the Apollonia City. There'll be buses leaving the Accra Mall at 8 a.m. See you there.
Yeah, sounds like a fun day
Sure,
out.
they will be.
Yeah. All right, listen, let's put this matter to bed once and for all. Do you have investments with any of these securities companies? Have you been told that if you disinvest before the maturity period, you will lose? Does that worry you? Stay tuned for an explanation. First of all, this is what happened last week. The Securities and Exchange Commission, the regulator for these institutions, issued a statement. Okay, I'll read a little bit of the one paragraph. It says, this public notice is to alert the investing and general public that the Securities and Exchange Commission, SEC, has directed all market operators to use the mark-to-market valuation method in the valuation of investment assets or securities and portfolios in the securities sector. The directive was issued on Thursday, 20th of October 2022, with reference number such and such, to provide consistency in the valuation of assets and portfolios in the securities industry, ensure that the portfolios reflect market values, as well as protect investors, especially investors of collective investment schemes. That's it. There's more detail in a Q&A or a frequently asked questions document that was also released by the Securities and Exchange Commission. So the question is this: all these posts flying around on social media that, oh, I went to take my money from my investment or securities company, and I was told that if I take the money today, I will not get full value. So that is a haircut. You are hearing people use the term haircut to describe this. But what is the reality of this arrangement, Winston?
Well, Kojo, so the reality is very simple. Now, when you invest, investments come with risk. I mean, our challenge has been that for majority of the people, because they see these investments, and particularly in the collective investment scheme, so that's when you go for, the fund managers will create a pool. All of us will put our money in the pool. Now, when we put the money in the pool, they would invest. Some of these will be very high-yielding investments. Others may not be. At the end of it all, what they will do is that they would share the profit amongst us all. Now, so for many of these persons, when they see their monies, they see that, first of all, you invested this amount of money and is yielding this value of interest. And that's exciting, isn't it? Mm-hmm. Because if you decide to go for your money, what you're going to see is that they would give you the principal plus the interest. That is, if all things are equal. And I'll explain why. Because these persons are investing. The reality also is that in portfolio management, one of the things we'll do is that you'd invest in risk-free. And risk-free here, we'll talk about investing in, normally government bonds. But government bonds have maturity periods. And when they reach maturity, you get your money, principal plus interest. If you decide to sell your bonds, you would sell it at the market value. And let me explain this. If you decide today that I no longer want my bond, you will go to the market, and then someone will make you an offer and say, I want to buy your bond at this rate. Or the bank or the investment institution that led you into investing can say, we want to buy it off you at this rate. Okay. The rate will be, would depend on the prevailing market circumstances and economic conditions in the country. It's not something that says, once you have a bond, you would sell it at, say, higher than the rate that you bought it. It could be if the terms are very favorable. So let me drive the point home. Years ago, I had a fund. I don't want to mention the name of the investment house, but if I say it, people probably will know. I had an Acquah fund. Mm-hmm. So I was monitoring. When I invested, at the time, the share price per unit was 10 pesos. So I bought a number of shares. As the shares were beginning to increase in value, my number of shares times the present value of the Acquah fund was what gave me the money. Now, mind you, the Acquah fund is a collective investment scheme. Over the period, I realized that money that I had accrued was beginning to go down. It was going down also because of the prevailing market conditions. What did I do? What I decided to do was that I withdrew part of the money, particularly a lot of the principal that I put inside. But once you do that, what you see is that your number of shares that you have in that particular investment reduces. So the next time the investment goes up, your money that you would have had if you had a lot of shares would actually reduce. Now let me come to the present condition that we're faced with. The present condition that we're faced with is very simple. The economy is bad. Nobody's running away from it. When interest rates are going up, it has an inverse relationship with bonds. The value of bonds are going to go down. What SEC ordinarily directs is that you should keep some bit of cash around so that when people come demanding their monies, you would give it to them. So all these fund managers have some component of cash readily available so that if people are coming for their monies, they can pay them. However, because of the current conditions and the demand going on, people think, okay, this is the time, and this is the point. Because interest rates are going up, people are going for government securities, as in treasury bills. They want to buy treasury bills. They're taking their investments. Now, because the interest rates are going up also, it's had an impact on some of these bonds or some of these stocks that the companies hold. Okay, you've gone out there, you say, I want to collect my money. They would have to now go to the market and say, I have this paper or note that I want to sell. How much are you prepared to pay for it?
That's right.
And the market will tell you, I am prepared to pay this amount. Now, when, economic conditions are bad, there's always a loss that would accrue to you. So what people are seeing is their, investment being given to them at the prevailing market conditions. What you have is that when I sell your investment that you bought 5 years ago or bought last year, this is the current value of your investment. However, if you wait and the economy becomes better, you would see an improvement in your investments. within the current circumstances, you don't have that good economic condition. But it also presents another good thing. The good thing is that for a lot of people who like to take risk, this is the time to invest. This is the time to invest because, look, if I am going to sell my bond, you buy my bond for cheap, you wait for maturity and you cash it out. Okay? If you buy it, when the times become better and you're buying it at a reduced rate, when the times become better, you certainly would get more from what you have done. So, yes, people are concerned because that explanation has not been there over the period.
Exactly.
We have always felt that once I put in money and I am seeing interest, I am entitled to all the money plus the interest.
Whenever I decide to.
Yes. What you are not ordinarily told is that once you are investing, you're buying shares.
Yes.
You're buying, so every share will be sold to you at a unit cost. So from today, let everybody go to his or her investment and ask the question, please, how many shares do I have? And what's the share value? Then do the multiplication.
So to simplify it, the thing has a certain value at all times.
Yeah.
The investment that you have made, the shares you've bought, it has a certain value at all times. Now, if you wait for the maturity period that you agreed on, no harm, no foul. You get your money plus the interest because that's their agreement. You are going to leave your money with them for a certain period. When that time comes, you get your money back plus interest. You've earned it. But if at any point you decide, oh no, I'm not interested in this investment anymore, I would like to sell my shares, that's also fine. Your shares will be sold, but they will be sold at the price that the market determines. So today, as you can well imagine, if you've bought bonds or treasury bills or whatever, the value is low.
Great.
So if you were to sell today, you will lose money. That is what people are being told by their banks, and it is not really, they are not grasping the communication well. I don't know whether the banks are not communicating it well, but to me it's a rather straightforward arrangement.
Yes, it's a very straight one. And let me just make this point. So a lot of the people are complaining about the collective investment schemes. And the collective investment schemes would be all of us. And those ones actually don't have a maturity period. And that's where the problem, for many people, they are concerned. It doesn't have a maturity period. So you've put in your money and you've said, oh, every month I will put this amount of money. But if you watch it critically, okay, now every month as you're even going, so for instance, let me use something like, say, EPAC. Anytime you buy, you're going to get shares. There's been instances that I have experienced it before. There's been instances where the value that I invested, that my money in EPAC has gone down below the principal that I put in there. It's happened to me before.
Yeah.
It's happened to me in the ARC fund before. So that happens because at that point in time, the value of the fund is low. It's gone down. And it's because of the market conditions at the time. You're investing in stocks, you're investing in other instruments, and all of these things, based on the returns that they give you, is what you will get. So, but if you went to the bank and said, I am buying a fixed deposit, and at the end of it, at the end of the year, I would get 20%. You would wait at the end of the year, you will get that. Yeah. If you went to government and bought treasury bills and said it's for 91 days, at 91 days, I get the 10,000 I invested plus the current rate of about 33% divided by a quarter. Divided by 20, a quarter. Fine, that's what you're going to get. But when you go for the collective investment schemes, because it's a whole pool, what would happen is that it's something that you do and then you can come for it when you want to. But when you want to go for it, as the SEC statement makes reference to, these should be done in consonance with IAS 37, provisions, contingent liabilities, and contingent assets. Let me just define a term of it. And the term, so today I brought my, financial, this thing. It says, look, this is a contingent liability. It is a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the enterprise's control or a present obligation that arises from past events but is not recognized because it is not probable for a transfer of economic benefits will be required to settle the obligation or the amount. Kojo, the long and short is that if you put your money in a fund and you want your money, you are not entitled to the exact amount of money because you are engaged in a risk.
Thank you.
And the market value is what you will get. If you want no risk, buy treasury bills, wait for maturity. Buy government bonds, wait for maturity, and get your money. But I am sorry. Yes, the fund managers will tell you, when they are saying, they say the current interest. Listen to them carefully when they talk to you. They tell you the current interest is between this and that. And we can promise you that you probably would get between 16 to 18%. Because they make the point assumptions based on the current circumstances. But there's a risk involved. And when the times change, they will change too.
Guys, I don't think that bits of the conversation is made clear.
So
we get
the treasury bills, that one is clear.
treasury bills.
But the
very clear.
collective investments, that's where the problem is.
So I'm saying that Winston explains it really well. But I'm telling you that as a person who went into that sort of investment, I did not get that understanding from the beginning. I knew it wasn't a fixed term. I knew I could go for my money anytime. But I think the attraction was the fact that you would get the interest would be compounded. So you knew that the money was growing. I mean that's the thing. That's the
So I guess what the investment advisor did not succeed in explaining to customers in your situation is the fact that there is risk attached to that investment.
yes.
I think that's the part that has not been properly communicated. There is risk. It's not a guaranteed return.
But you don't
So
expect that your principal will be affected.
The point
at
is,
a time like this.
you see, well, I know that the time like this makes the stakes high, but the investment works the same way and has always worked the same way. It's not a new rule that has been introduced. That's an important point to make. It's not a new rule. That's how things are. If you buy an investment like that, your return is based on the value of the thing you've bought. The value can go up, it can come down. If it comes down below what you spent, you lose money. So you've heard of people, on the stock market losing money, right? You invest in a stock, the price goes down, you lose money, right? It's not a guarantee. You're not guaranteed that you're going to take profit home. But for some time, if things have been going well, you can be lulled into a false sense of security where you think that your money is always safe, but there is risk.
Yeah, and so the other point is that in times, and I started by saying that you're supposed to have a certain amount of cash so that when people come, you do it. Now, in previous years, because we have not had this kind of demand for the returns from a lot of people, when you go, you get your money. There's no problem. But the moment, and you see, as I sit here, if you want to sell anything to me at this point in time, when I know people are demanding, I'll give you a very low, quote, because I know that people need their money. And so if you need your money urgently, I said, this is what I can offer you. It's a paper. It's a note that you're selling to me. I said, this is what I can offer you. Accept it or go away. And so I've had discussions with people who have said, for those of us who like risk, this is the time we want to invest. And this is the time we're going to get into, buying bonds from people who want to sell their bonds. But the problem also is that, and let me
Because
just...
it will be cheaper.
It will be cheaper. Let me make this point finally. From today, let everybody go to his investment house and begin to ask for the unit prices of their investments. You realize a lot of us, and I made this point that when the ACK fund started, when it was introduced onto the market the first time, it sold at 10 pesos per share. 10 pesos. So any amount you are investing into the ACK fund will be divided by the 10. That will be the number of shares that you have. So if it goes to 11 pesos, you would have to multiply. So for instance, if I paid 100 Ghana cedis, if I put in 100 Ghana cedis, that would give me 10, if I put 100, it would give me like 1,000 shares. So if it goes to 11, it will be 0.11 times the 1,000, and I probably will get 110 Ghana cedis. So that's when I'll see my interest. Now, if it now goes down to 9, I'll get the 0.09 multiplied by the 1,000, and I probably will get a 90 Ghana cedis. But because in a lot of the instances, it goes up, we don't watch. We're very happy that, it's going well, it's going well, it's going well. But going forward, let people begin to pay a bit of attention to, the details of the investments they're engaged in.
We don't even have to ask the bankers or the investment company. They send us statements.
They'll send you statements every month.
Except that
Check.
we're interested in the bulk figure and how much more money you've gained.
Exactly. So you see, a lot of you will be interested in how much you've gained, how much you're not gaining. But if you were very interested in the gains previously, if a lot of us had been investing for a very long time, would have seen that around the 2010s, there was a problem where these stocks were going down, and would have realized that this is not the first time we're experiencing that. But to be very honest, like the firms have advised, and I end on this note: if you don't have use for the money now, don't go and withdraw. Don't do that because of what you perceive to be risky times. Yes, it may go lower now, but if I were you and I had some money, I probably would invest now. And I end on this note, even me seated here offering you an explanation. It became obvious at the point that my investments, the percentage that I was having initially, it was going down. Then I realized that the market was reacting to the situation that we're in. And that's the end of it.
That is all. Okay, so it's very important that you get a full understanding of this. Listen to what your bank is telling you. Okay, they are legally obliged to give you the truth. So if they tell you this is the situation, that is the situation. Okay, and more importantly, if you panic, you spread the word, the fake news, and people rush to that institution, you are endangering your own funds. Because even the healthiest financial institution cannot survive if too many people demand their money at once.
Yeah.
So don't endanger your own money by spreading false information. That's very important. All right. There's more to come on the Super Morning Show. Did you go for the demo? No? Why not? We'll talk about it after these.
Super Morning Show.
Stop lying to us. Stop deceiving us. He was not even close to the pole. That is why I bought this Samsung television. This football season, it is Samsung all the way.
Enjoy massive discount, up to 50% discount on selected items. Enjoy this new football season on a new Samsung television with as big as 90